G'day. I wanted to go through what is effectively a practice exam problem for accrual accounting. I hope it gives you some confidence that you've got the basic calculations done already and that there's an element of common sense under everything. But before we go too far, let's think about what we want to do. We want to get to a situation where we've got a set of accounts just like is in front of us now, and we're going to end up with a balance sheet so that sets out the assets and liabilities of account, and an income statement that sets out the revenue and expenses of a business. So the first thing you're probably going to do is have to classify all of these different accounts. Are they assets? Are they liabilities? Are they expenses? And you should be fairly comfortable when you say, for example, looking at sales, saying, yeah, that's an income account. And remember, you will have the front page of your textbook, the chart of accounts, which gives you some nice clues. So let's move and have a look at the style of problem that we've got to do from this. This is very similar to the sort of thing you're going to be asked to do. You're going to have these adjustments that happen around the balance date, 30th of June. Whichever year it might be. So here are some of the balances. A stock take shows the inventories to be $38,000, where in the accounts they sit at $38,700. Furniture is to be depreciated. We've looked at that. Motor vehicles to be depreciated. We've looked at that. Provision for doubtful debts. We haven't looked at that, and I'm actually going to skip over that in this presentation. But basically, we've got to say we've got these accounts receivable, but probably, unless we're brilliant and we've got the best customers in the world, we're not going to receive all the money. So how do we kind of make it more realistic rather than the accounts reflecting we receive all the money? There's some wages that are owing on the balance day, so we're going to have to pay those. Copyright. We've talked about copyright. It's an intangible asset, and it will be used up over a period of time. In this case, 5 years. Rent was received from tenants on the 1st of May for 3 months of rent in advance. So some of that rent, May, June, July, well, 1 month of that rent doesn't happen in that period, so we're going to have to make an adjustment there. Commission has been earned, but not recorded, so we're going to have to add some commission revenue. An advertising campaign has been paid for, but extends into the next accounting period. Some government bond interest has been accrued but hasn't been paid to us yet. That's an investment that the business has made. And there's a loss related to a fire. So we're going to look at each of these things individually. So let's move to look at the calculations that we're going to make. So the first thing we look at is this stock take showing $38,000. And what you might be best to do as you look through this is if you have the chart of accounts here, because this becomes very, very important in understanding what's happening. So most of the time you're going to start here. So for example, the inventory control account is $38,700, but the actual stock account, it's the stock take, only shows $38,000. So what do we have to do about that? The inventory control account has to reflect what's in the stock take. So it's reduced to $38,000, and because we can't just make up numbers, we have to create a new account called the inventory adjustment account. And that reflects the $700 that has been lost. It sits so that's the first step. And the inventory adjustment is part of the cost of goods sold. So if you remember, we haven't looked at income statements for a while, but remember, the cost of goods sold is that first part, which looks at the sales less just the cost, not the other expenses like electricity and wages and so on, just the cost of goods sold. We now move on to 2 depreciation examples. I'm hoping these make a fair bit of sense to you. The depreciation of furniture. When you look at the accounts that you've got, hopefully you've got sitting in front of you, you can see that the furniture account has a value of $83,000. We're told the residual value is going to be $10,000 and it has a useful life of 10 years. So that means the amount that's going to fall over those 10 years is going to be the starting value of 83,000 less the 10,000 finishing value, 73,000. And that means it's going to fall by $7,300 a year. So the depreciation for the year is going to be $7,300, but importantly, we've got to go back here and say, well, is there already an accumulated depreciation account? There is. It's got the $11,700, so we have to add to that this year's depreciation. The motor vehicle is a little bit more challenging. So if we look at our motor vehicle accounts, we can see that we're starting with $13,400 of accumulated depreciation, and the motor vehicle started off with a value of $55,000. So it reduces in value by 25% each year. So if we start with $55,000 and we work out 25%, 25 divided by 100 multiplied by 55,000, it equals $13,400. So that's the first year's depreciation, and after that, the car is worth $41,600. That's where we're up to now, because we know we've got $13,400 in accumulated depreciation. Now it's going to go down by 25%. So this current year's accumulated depreciation, or depreciation, $10,400. We add it to the previous year, and we've got $23,800. That's going to come away from the value of the car to give you the remaining value. We're going to skip over bad debts. I said we will look at that separately later this week. But it's not a complex calculation, as you can see there. You might even choose to work your way through what's there. Remember, the bad debts is the existing account there, and we're adding, it's got to be, we were trying to set it to 8% of the value of accounts receivable. Now, wages. We've got a situation in our problem where wages are $6,200 a fortnight. Right, so if it's a 5-day working week, wages are going to be 10 days over a fortnight, wages are going to be $620 per day. So there's two days of wages that we owe, right? So it's an accrued expense. And so what has to happen is those 2 days have to be acknowledged as an accrued expense, $1,240, and we have to increase our wages by that amount, $22,000, to recognise that there have been those wages in the period. Copyright. Now, there's a few things in the question that aren't quite right. And what we've been making sure here is that there is 6 months of copyright. This reflects 6 months of copyright. Right, so the copyright is $10,000 over 5 years. That's what we are told in the problem. And because of that, we know it falls by $2,000 a year. In this case, while the dates are a little wrong in the question, you'll assume that there'll be a 6-month period, and that'll be $1,000 worth of copyright that falls in value. So you'll then have accumulated amortization. That's the name for effectively what is the depreciation in value in a non-tangible asset will be $1,000. And it will reduce your copyright by $1,000 when we get to the balance sheet. We're getting through. We've only got a few more things to do. Rent. So you've actually got something that you're renting out in this case. Right? So it's received from tenants for 3 months of rent from the 1st of May. Well, May and June fall in the accounting period, but the third month doesn't. So we have to find out what the value of that is. So we can divide it and work out that the $2,430 in total is $810 per month. So $810 is going to be unearned revenue, and we have to reduce our rent by $810. We've got a sales commission amount that hasn't been recorded yet. 10% is the commission we're paid. We sold $8,500 worth of stuff. 10% of that means we've got $850 for commission revenue, and we have to increase our commission revenue by that amount. Right? So that hasn't been paid yet, but we've done the work. We've earned that. So we set up an accrued revenue account for $850. Advertising. In this case, we've prepaid a whole lot of advertising, so we're looking at a prepaid expense. It's a 6-month campaign that we paid $3,000, so it's $500 a month. 2 months, $1,000 belong in the accounting period, but 4 months are in the next accounting period. Right, so that 4 months is worth $2,000, so we've got a prepaid expense of $2,000, and we reduce advertising to $2,600, reduce it by that $2,000 amount. And then we've got a calculation on government bonds. And I won't go into too much detail with this. A government bond is a style of investment. In this case, it's paying income once a year, but you've owned it for 6 months. So it's a 10% return. So you're going to get $500 of interest over a year, but over 6 months you're only going to get half of that, $250. So you've got some accrued revenue. So we will add that to the revenue, but in this case we'll look at that one in a little bit more detail. The loss on the fire, that just means it's an extraordinary event. So it's just about where it sits. It's never happened before. They're the details you're given. So the details you ask, the business never had a loss because of a fire before. So we're going to put it as an extraordinary event in the accounts. So look, that gives you the basis. Let's have a look at where we have to get to be successful with this. The first thing we'll go and have a look at is the balance sheet. Remembering that the balance sheet sets out assets and liabilities. And we're going to have to, let's see how we go. Look at that, rotated correctly the first time. We'll even zoom in a bit just to, or maybe we won't. So let's have a look at what we've got. Current assets. We have to go through the accounts and look at what we've got. So we've got the bank account, deposits at Corp. We've got some assets that we've worked out, prepaid expenses and accrued revenues. Our inventory account, which we've adjusted. So remember, we don't put the $38,700, we put the adjusted amount in. We've got our accounts receivable, provision for doubtful debts, which we'll have a look at a bit more detail. So some of the other ones I've highlighted here, for example, we've got some unearned revenue that we've got as a liability, some accrued expenses that we haven't paid yet, so for example the wages there, and then we've got the non-current assets. So we've got our furniture less our depreciation so far, our motor vehicles less our now 2 years depreciation. There's a year before this account and this account. The copyright in the $1,000, but then we've got some amortization that which reduces it to $9,000. So that's what we're doing with our balance sheet there. And feel free, if you want to have a bit more of a look at it, pause it now and have a look at that. But I'll also just quickly look at the income statement, because this is where we need to get to with our problem solving. So with our income statement, here's our important things. So we've got our cost of goods sold. That's the first thing. Right? Our sales, sorry, is our first thing, less the cost of goods sold. We've got the inventory adjustment goes up here, and that gives us our gross profit. Then we've got our other revenue. So remember, we adjusted commissions. There's some discount revenue of $800. And if you want to check this, again, go back to the accounts that you've got. These were all given in the accounts. There's some rent revenue, but of course our accounts show $14,310 for revenue. Well, we had to adjust that because there was some that was received from the next period. The government bond interest, again, that was an adjustment there, and that gives us, after looking at the gross profit, that gives us the other revenue to take it up to $181,000. And so now we look at the other expenses, right? And we just put those in as they are. We've had to adjust some of those. So, for example, we've got wages. Now we've had to use the depreciation for the year for furniture. We've had to calculate the depreciation for the year for the motor vehicle and amortization of the copyright. Very important that they are only the amount that happens in the year. So there's accumulated depreciation on the furniture there was $11,700 in the previous year plus $7,300, but we only use the depreciation from this current year. Right. Then there's some financing activities, the bad debts, which gives us an operating profit, and we say we've got this one extraordinary event of the fire to give us a net profit. So that gives us a basic overview of what we've got to do and an example to do it, and we'll be working on whatever things we need to do to fill the gaps in so that you guys can get that done for the exam in Exam Block.